You know that feeling. You're faced with this, like, mountain of information, maybe for work, or you're just curious about something new. And all you really want is for someone to just cut through it all, pull out the important stuff, and, I don't know, make it make sense. Well, that's what we try to do here. Today, we're going to tackle something pretty complex, actually. It's a financial product called the Direxion Daily MSCI India Bull 2X shares. Bit of a mouthful. You might know it as INDL. It trades on NYSE ARCA. We've got the summary prospectus right here, and our plan is to, well, dig into it and pull out the key insights for you.
Yeah, our mission today is pretty straightforward. We want to understand what this fund, INDL, is supposed to do, how it actually works, and maybe most importantly, really get into the risks. The prospectus is pretty explicit about them, so we'll look directly at what it says.
Okay, but before we jump in, and this is super important, really we need to be crystal clear. This deep dive, it's purely for informational, educational purposes, okay? We are literally just extracting and explaining what's in this document, the prospectus. This is absolutely not financial advice, not investment advice, not in any way. Products like INDL are specialized, complex. You really, really should talk to a qualified financial pro for any investment decisions, someone who knows your situation. Our goal here is just to help you understand the mechanics, the stated risks. We're not recommending it. Just trying to shed some light. All right, got that important disclaimer out there. So let's unpack INDL, Direxion Daily, MSCI India Bull 2X shares. What's the main goal here? What's it trying to achieve?
Okay, so its core objective, stated right up front, is to seek daily investment results. That's before fees and expenses of 200% of the daily performance of the MSCI India Index. And the key word there, you really got to emphasize it, is daily. The prospectus hammers this home. It does not seek this 200% return for periods longer than one trading day.
Right, that daily leverage 2X part, that seems critical. What does it actually mean if you hold it for like a week or a month? Does it just mean 2X the index's return over that week?
No, that's the common misconception. It means the fund tries to magnify the index's performance each day, but, and this is the direct quote basically, the return for investors that invest for periods longer or shorter than a trading day should not be expected to be 200% of the performance of the index for the period. Why? Because your return over, say, a week is the result of compounding those daily returns. And the prospectus says this compounded return will very likely differ from just 2x the index's weekly return. It even points out that longer holding periods, more index volatility, and the leverage itself all increase this compounding effect. It can seriously eat into returns over time.
Wow. Okay, so compounding can actually work against you here, potentially. Yeah. And the prospectus is blunt about who should even consider this. It says, the fund is not suitable for all investors. Who is it for then?
Yeah, it's very direct. It says it's designed only by knowledgeable investors who understand the potential consequences of seeking daily leveraged 2x investment results, understand the risks associated with the use of leverage, and are willing to monitor their portfolios frequently. It doubles down, saying it's not appropriate for investors who do not intend to actively monitor and manage their portfolios.
So basically, hands-on, eyes-on, everyday kind of investors.
Exactly. And the warnings keep coming. Like, the fund will lose money if the index's performance is flat over time. Or even, it is possible that the fund will lose money even if the index's performance increases over a period longer than a single day. That's the compounding effect again, and the really stark one. An investor could lose the full principal value of his or her investment within a single day if the index loses more than 50% in one day. 2x leverage cuts both ways. Hard.
Those are, yeah, pretty serious warnings. Okay, let's pivot slightly. The underlying thing it tracks is the MSCI India Index. What does that index actually represent? And why India specifically as an emerging market here?
Sure. The MSCI India Index tracks the performance of large and mid-cap stocks in India. It covers about 85% of the Indian stock market, so it's pretty broad. As for emerging market, the definition in the source is basically an economy that's industrializing, historically had lower income, maybe less market transparency, but is now making reforms, opening up to foreign investment, and generally improving economically. Think high growth potential, but also distinct risks.
Makes sense. And what kind of companies are in this index? Is it diversified or concentrated?
Well, as of the end of 2024, it had 156 companies, but the key thing noted is its concentration. It's heavily weighted towards the financial sector. And because the fund tracks the index, INDL itself will also be concentrated in financials, mirroring the index.
Okay, so INDL wants 2x the daily return of this India index, which is heavy on financials. But you mentioned it doesn't usually buy Indian stocks directly. How does it get that exposure then? Seems kind of counterintuitive.
Right, it's done indirectly. The strategy is, under normal conditions, to invest at least 80% of its assets in things like swap agreements, or maybe securities of the index, or even other ETFs that track the index. These are all put together in a way that provides that 2x daily leverage. It specifically says it generally will not invest directly in the Indian securities markets, but mostly uses ETFs and swaps that are linked to ETFs tracking the index.
Swaps. Okay, can you break that down simply? What's a swap agreement in this context?
Think of it like a contract. The fund agrees with another party, usually a big financial institution, to exchange cash flows. The fund might receive payments based on the 2x daily return of the MSCI India Index, and in exchange, it pays a fee or some other rate. It's a way to get the economic exposure without owning the actual stocks. It's a common tool for leveraged and inverse funds. And to keep that 2x target precise, the investment advisor, Rafferty, has to rebalance the portfolio every single trading day, usually near the close.
Every day.
Every day. And that constant shuffling means, as the prospectus notes, high portfolio turnover.
Okay, this brings us neatly to the risk. You've touched on some already, but the prospectus lists a lot. It even says the fund is not a complete investment program. This section feels really, really important. Let's dive in.
Absolutely crucial. The first big one is effects of compounding and market volatility risk. We talked about it, but it deserves focus. Again, long-term performance will likely differ from just 2x the index's return. Compounding's impact gets worse with higher volatility and longer holding periods. The prospectus gives examples. If the index is flat, 0% return over a year, but volatility is 25%, the fund is expected to lose 6.1%. If volatility hits 100% with a flat index, the expected loss jumps to a massive 63.2%.
Wow, just from volatility, even if the market itself goes nowhere overall.
Exactly. And historically, the index has been volatile. Its 5-year annualized volatility was over 20%, and it hit over 33% in one calendar year. So this isn't just theory. It's the core reason this fund warns against long-term holding. It's like a built-in decay factor in volatile markets.
Okay, so flat market can mean losses over time. Got it. What's next? Leverage risk.
Yep, leverage risk. Because it's aiming for 2x, losses are also magnified. A 1% daily drop in the index means roughly a 2% drop in the fund's value before costs. And like we said, a big enough single-day drop in the index over 50% could wipe out your entire investment. Total loss is possible.
Okay. And it uses derivatives, like swaps. That carries its own risks.
Definitely. That's derivatives risk. Swaps and other derivatives can be complex. They might not perfectly track the index, correlation risk. They can be more volatile than owning the stocks directly, and sometimes losses can even exceed what you initially invested, though that's less common for fund investors directly. Plus, there's complexity in valuation and potential illiquidity.
And who are they making these swap deals with? Is there risk there?
Good question. That leads to counterparty risk. The fund relies on these other institutions, counterparties, to fulfill their side of the swap agreement. If a counterparty fails, goes bankrupt, or just can't pay the fund, could suffer losses or might not get the exposure it needs. This risk is bigger if the fund only uses a few counterparties.
Right. And you mentioned daily rebalancing. What if that goes wrong?
That's rebalancing risk. If the fund can't rebalance properly at the end of the day, maybe markets are chaotic or there are technical issues, it might end up with the wrong level of exposure. Could be more than 2x, could be less. Either way, it means the fund isn't meeting its objective, which could lead to unexpected losses or gains.
And does it always track the index perfectly, even on a daily basis?
Not always perfectly. That's daily index correlation risk. Things like fees, transaction costs, market disruptions, or even how the fund values its holdings can create small tracking errors. The prospectus notes this risk increases on days when the index is really volatile near the market close, right when they're trying to rebalance.
Okay, now let's circle back to India itself. Even though INDL uses swaps and ETFs, it's still tied to the Indian market, right? So India-specific risks apply indirectly.
Exactly. You can't escape the underlying market's risks. So you have Indian securities risk and general emerging markets risk. For India, the prospectus mentions things like political or legal uncertainties, potential government intervention in the economy, currency issues, fluctuations, or even blockage. Risks like nationalization, less developed or liquid markets compared to, say, the U.S., and rules set by the Reserve Bank of India that might limit foreign ownership.
And emerging markets in general.
Yeah, broader risks include potentially higher volatility, lower trading volumes, making it harder to buy or sell quickly, higher inflation risks, political instability, Even the chance of market shutdowns, government limits on foreign investment, and less standardized accounting practices. These all add layers of risk to the underlying index INDL tracks.
And since the index is heavy on financials...
Right, you have financial sector risk. That sector is sensitive to regulatory changes, economic downturns, interest rate moves, credit downgrades. The prospectus even flags competition from things like DeFi and the ever-present risk of cyber attacks on financial institutions.
Okay. Lastly, just being an ETF has its own quirks, right? Even a plain vanilla one.
It does. There's absence of active market risk. No guarantee people will be actively trading INDL shares, which could affect liquidity. Market price variance, risk the price you buy or sell INDL shares at on the exchange might be slightly different from its actual underlying value, net asset value or NAV. Could be a premium or a discount. And trading cost risk. When you buy or sell shares on an exchange, you have costs like the bid-ask spread, the difference between buying and selling prices, and brokerage commissions. Those add up.
Whew. That's a lot of risk factors to consider. Okay, shifting from risks to costs, what are the annual fees?
The prospectus shows annual fund operating expenses total 1.24%. That breaks down into management fees of 0.75%, other expenses of 0.14%, and something called acquired fund fees and expenses of 0.35%. That last part often comes from the fund investing in other ETFs, which have their own fees.
So 1.24% total, how does that translate into dollars over time?
To give an example, a $10,000 investment, assuming a 5% return each year. After 1 year, the cost is about $126. After 3 years, $393. 5 years, $681, and 10 years, $1,500. And remember, that's before any brokerage commissions you might pay to buy or sell the shares.
Gotcha. What about portfolio turnover? You said it rebalances daily, which sounds like a lot of trading.
Yeah, it's interesting. The reported turnover rate in the prospectus was 0% for the last fiscal year.
0%. How?
Because of how it's calculated.
Yeah.
The prospectus clarifies this 0% figure is calculated without regard to cash instruments or derivative transactions. Since the fund relies heavily on derivatives like swaps, which are constantly adjusted, if those transactions were included, the turnover rate would be significantly higher, like extremely high. High turnover means more transaction costs potentially embedded in the fund's performance, and it can also trigger more taxable events for investors holding it in a taxable account.
Okay, that makes more sense. Let's look back then. How has INDL actually performed? Understanding, of course, that past results don't predict the future.
Right, crucial disclaimer. The historical data shows big swings. The bar chart in the prospectus shows, for example, the worst calendar quarter return was an index of 79.86% back in early 2020. The best quarter was a gain of 58.48% in early 2017, so huge volatility. Looking at the average annual total returns before taxes ending December 31, 2024. For 1 year, it returned 7.63%. For 5 years, it was actually negative 1.39% per year. And for 10 years, also negative 2.13% per year.
Negative returns over 5 and 10 years. How did the underlying MSCI India Index do over those same periods?
That's the really telling comparison. The MSCI India Index itself, remember this has no fees deducted, returned 11.22% for the 1 year, 12.52% per year for 5 years, and 8.73% per year for 10 years.
Wow, so the index was up significantly over 5 and 10 years, but the 2X fund tracking it daily ended up with negative returns over those same periods.
Exactly. It starkly illustrates that compounding effect and the impact of fees and volatility over time. It shows why trying to get 2X, the index's long-term return, by holding this fund just doesn't work out mathematically. And the prospectus itself says, past performance is not necessarily an indication of how the fund will perform in the future, and that showing annual returns should not be interpreted as suggesting that the fund should or should not be held for long periods of time.
Understood. Reinforces the daily aspect yet again. Any quick notes on taxes or conflicts of interest mentioned?
Yeah, briefly. Fund distributions are generally taxable as ordinary income or capital gains, unless it's in a tax-deferred account like an IRA or 401k. And there's a note that the fund or its advisor might pay brokers for selling shares, which could create a conflict of interest, potentially incentivizing them to recommend INDL over other options. Yeah. Standard disclosure, bit worth noting.
Okay. We've covered a lot. The objective, the mechanics, the huge list of risks, costs, performance. So pulling it all together, what's the main takeaway for you, the listener, trying to make sense of this complex product?
I think the absolute key takeaway is that INDL is a highly specialized tool. It's leveraged, it's designed for daily results, and it comes with significant complex risks, compounding, volatility, derivatives. These aren't minor details. They fundamentally shape how the fund behaves, especially over time. The prospectus itself tells you it's not for passive investors. It's for knowledgeable people actively managing and monitoring daily. So really understanding these mechanics and risks is paramount. Knowledge truly is your best asset when looking at anything this complex.
Absolutely. And maybe a final thought to leave you with. Given everything we've discussed, especially the challenges of compounding and volatility for holding periods longer than a day, and that very specific target audience of frequent monitors, how does a product like INDL actually fit, if at all, into traditional investment thinking that usually focuses on long-term growth? What kind of very specific market view or investor goal would truly align with using something built for magnified daily moves in an emerging market like India? Something to ponder. And one last time, because it's that important, this was purely educational, based on the prospectus. This is absolutely not financial advice or an investment recommendation. Always, always consult a qualified financial professional who understands your personal situation before making any investment decisions. Thanks for diving deep with us today.